Now in this video, I want to talk to you about why I decided to go with dividend growth investing. What is up everyone, it's David here. Now I just want to say that just because I picked dividend growth investing, it doesn't mean that dividend growth investing is more superior to growth investing. Now they both have their ups and downs, and later in the video, I'll be talking about why I personally prefer dividend growth investing. Now my goal with my videos is to bring you along to my investing journey so you can see why and how I've decided to invest in different stocks and what I'm using so that you can come to your own conclusions in terms of what is the best investing strategy for yourself. Now the video is broken into two main parts. The first part is what is dividend growth investing, and the second part is all the reasons why I personally prefer dividend growth investing. Now as usual, if at any point this video was helpful to you, it'll mean a lot to me if you could just gently smash that like button, because that will help out my channel out a lot. Now without further ado, let's go. So what is dividend growth investing? Now with dividend growth investing, what you're ultimately doing is that you're building a portfolio of companies who are increasing their dividend payouts every year consistently. Not every company who increases their dividends are sustainable over the long term. So what we're really looking for is companies with strong moats, strong fundamentals, and a positive future outlook in the industry, and most importantly, financing their dividends with earnings growth and not debt. And that's essentially what dividend growth investing is. Alright, so let's talk about why I personally prefer dividend growth investing. Now, I prefer dividend growth investing for three main reasons. The first one is return, the second is stability, and the third one is an additional source of passive income. Now, when it comes to returns, a common criticism of dividend growth investing is that it underperforms against the broader stock market. Well, not true. Let me explain. Now, the table on the screen right now, courtesy to Harvard Funds, measures the average annual return from 1972 to 2019. And it shows that dividend payers have an annualized return of 12.72%, beating the equal weighted S&P 500 index return of 12.29%, and the 8.57% of companies who just never paid a dividend. Now, if we use the dataset from the table that you just saw and invested $100 from 1972, we can see that the dividend growers have historically outperformed the non-dividend payers by a mile. Not to mention a lower volatility for dividend growers as well. It just means that it's less risky. So when it comes to returns, dividend stocks is definitely up there with growth stocks. And fun fact, dividends contribute to over 40% of the total return in the S&P 500 index from the 30s to 2019. And the power of dividends and also compound interest is also really interesting too, as you can see on the screen. Now, if we just look at the S&P 500 index, which is the broader market, if you will, without dividends, a $10,000 invested in early 70s will only be about $350,000. If you reinvest all of the dividends at the end of 2019, you would have $1.6 million. Of course, I am well aware that I am cherry picking facts to fuel my confirmation bias because I am pro dividend growth investing. But the point I am trying to make is just that dividend growth investing can generate competitive returns too, if not a better result. Plus, what I really like about dividend growing companies is their long-term, value-driven view of making decisions. After all, if you're paying half your earnings to shareholders, you have to be more selective in terms of what acquisitions you're going to make, what kind of growth opportunities you're going to take on over the long term, and how much debt you're going to take on to maintain a healthy balance sheet. Now, another reason why I chose dividend growth investing over purely investing in growth stocks is stability. Now, with growth stocks, capital appreciation is the only way you can grow your money. So if at any point in the future you decide that you want to retire or you want to fund your children's education, you have to sell down your stocks in order to get the cash to pay for those things. But the problem is the stock market is extremely volatile and we'll never know what happens in the future. So what if at the moment that you need the money and the market is going through a downturn like what we're experiencing right now, where your gains over the last 5 to 10 years are suddenly wiped over a short few months? What will you do then? Forced to sell at a price that you originally bought at? Now that's a very extreme example for me to demonstrate a point. But I just personally prefer companies with strong fundamentals to grow my income stream over time so that I get a paycheck no matter the times are good or times are bad. Not to mention the capital appreciation that comes with a really high quality dividend paying company as well, and the option to choose what to do with that dividend payment. Sometimes I just want to choose what I want to do with that dividend payment instead of the company deciding what to do with that money. I like having the option, and I personally like companies who can weather the storm no matter the times are good or the times are bad over the long term. Now, the third reason why I chose dividend growth investing over purely investing in growth stocks is an additional stream of passive income. Now, in some of my previous videos, I talked about where majority of my income does come from digital marketing, client engagement. And what that really means is that I'm helping other companies with their Facebook ads, Google ads, and also SEO, which is search engine optimization. Now, digital and growth marketing will always be my bread and butter, and I love it. And I don't think I will ever give it up, even if I'm old. But the thing is, my income right now is purely dependent on them, and that's a very debilitating feeling that it just makes me feel like I'm not truly the captain of my ship. And what I deeply value that dividend growth investing will give me is that additional stream of income. Now, that additional stream of passive income that you don't really have to do a lot of things for it's almost a sense of independence, that at some point you no longer need anyone else to cover your expenses because your investment will cover all your expenses, and they'll pay you a dividend check every year no matter the times are good or the times are bad. And I accepted that's gonna take some time, and I'm absolutely okay with that. And I'm hoping to take you on the journey with me so that you can see my ups and downs, so that you can learn from my downfall, and hopefully I can share the things that I've learned with you as well so that we can both grow together. Now, in closing, dividend growth investing is by no means perfect. In a downturn that we're currently facing right now, it's supposed to perform better than the broader stock market. But in reality, it's slightly lagging behind in the first quarter of 2020. And one of the major reasons is that dividend aristocrats, which is basically companies who have increased the dividends for 25 years consecutively, are underweighted in tech. And the public health crisis that we're experiencing currently requires more support from remote work access and an increased reliance on e-commerce, which the dividend aristocrats simply just don't have. And you can see here on the screen that generally speaking, in most downturns, dividend aristocrats have outperformed the broader stock market. It's still a little early to tell, but in the first quarter in 2020, they are lagging behind. I don't really see that as a big problem, since incorporating a few tech companies into my dividend growth portfolio would really just balance out the portfolio. On that note, I also mentioned in my previous video that finally in Australia, we have a company that will allow us to build dividend growth portfolios with individual stocks brokerage free, and that's Stake. Now, I'm not sponsored by them by any means, but I'm just really excited because one of the major things when it comes to investing in Australia is transaction fees. For me to build a dividend growth portfolio here, I'll be broke by just transaction fees. Not to mention even trying to buy individual US companies. Now that I'm able to build a dividend growth portfolio with individual US stocks using Stake, I want to show you the ins and outs of how I'm executing my dividend growth investing strategy in my second video every week, so that you can see what I'm investing into, why I'm investing into those companies, and how the recent market news have changed or shaped my investment thesis. Also, if you want a free stock of either Nike, Dropbox, or GoPro when you fund your account with Stake, the link is in the description below. Now, as usual, if you find this video helpful, make sure you gently smash that like button, because that really helps out my channel out a lot. And remember to subscribe, click onto the bell so that when I reveal my dividend growth portfolio in just a little bit, you'll be the first one to know. And until next time, sorry my backdrop is a little bare at the moment because I'm actually moving, but I still want to create a video for you. But he will do the honors. See you later.